Good morning. This is Horizon's Middle East and Africa. Our top stories this morning. Oil rises as the United States completes a fresh set of strikes in Iran for a second day in a row. This is after President Trump accuses Tehran of dragging out peace talks. Global equities hit a one-month low as the tech-led sell-off deepens and the war in Iran shows little sign of ending. Plus, investors gear up for SpaceX to go public, with the order book believed to be more than 4 times oversubscribed. That includes Gulf sovereign wealth funds ordering shares worth several billions of dollars. It's just gone 8 a.m. across the Emirates. I'm Abir Abu Amr in Dubai. Big geopolitical focus today, but let's turn to see how markets are doing before we head into the big story. Now, U.S. futures are turning upward this morning, 0.4% higher. This is after a softer than expected CPI print out of the United States yesterday, despite headline inflation being at a 3-year high. Some of the underlying risks still exist in the United States. We'll talk about that later in the show. Asian equities turning downward, 0.4 lower. The geopolitical tensions from the Middle East escalating by the day are catching up to equities in Asia. Kospi in South Korea, however, is trimming some of the losses from earlier in the session. And Brent crude is about 2% higher, $95 a barrel almost, because of those fresh strikes that we saw in the region today. Iran and the United States exchanging fires yet again. And then the yield on the 10-year treasuries not really doing much today. Again, the CPI print was softer than expected on some aspects yesterday from the United States. Well, let's turn to the geopolitical story in the region. Oil is rising as the U.S. completes a fresh set of strikes in Iran for a second day in a row. Central Command says multiple locations were targeted, including military surveillance capabilities, communication systems, and air defense sites. That is after President Donald Trump accused Tehran of dragging out talks on an interim peace deal.
We hit them hard yesterday, and we're going to hit them again hard today, in case you miss it, in case you don't turn on your television set. And we'll see what happens with the deal. We were really close to a deal, but they keep tapping us along. They keep playing us for suckers because, you know what? They dealt with some very stupid precedents.
Let's discuss further with William Roebuck, Executive Vice President at the Arab Gulf States Institute and former U.S. Ambassador to Bahrain. Ambassador, thank you for joining us this evening, your time. Look, the latest escalations that we've been monitoring over the morning, are we entering a temporary phase of escalations, or is it a fundamentally more dangerous phase in this war that we're heading into?
It's a bit of both. I mean, it is. It appears so far as another phase in the current messy ceasefire. The way that President Trump has framed the attacks, the way that CENTCOM described them as completed, the fact that they are focused on military targets, indicating they're looking for, a diplomatic off-ramp. There's nothing in the language so far that indicates they are planning a long-term planned escalation. So I think what we're talking about is a spike in tensions, probably provoked by the shoot down of the helicopter yesterday. And unless there's something unpredictable that happens, I expect it to revert back maybe to the messy ceasefire that we've been seeing, no war, no peace, of the last couple of months.
But look, I mean, Iran has sort of calibrated its response. It is retaliating by attacking countries in the region, not what we've been seeing over the start of this conflict. But do you think that the guardrails may start to break down from the Iranian side if these attacks by the United States continue to happen?
I mean, it's always possible. So far, despite the absolute significant pressure, military pressure that Iranian regime has been under for months, they have demonstrated a certain level of coherence, including strategic coherence, the ability to pull together decision-making under difficult circumstances and structure targeting efforts in ways that seem to indicate there are guardrails and that they are trying to make sure that they act in ways that don't create escalation that could be uncontrolled.
And look, I'm also mindful of Israel's part in this. Now, over the past 2 days, Israel has been relatively quiet with the incursion in Lebanon continues. And this whole thing started with Israel really attacking Iran. How do you view the relationship between President Trump and Prime Minister Netanyahu at this point, with all the friction that has been reportedly the case between them over the past couple of months?
I think they have a close relationship, but it's a contentious relationship, and there are moments when it becomes tense. And I think President Trump has indicated most recently one of those moments where he, according to the readouts we got from the White House and the media, there were acrimonious exchanges. The president demanded that Prime Minister Netanyahu and Israel pull back from the escalation that they were conducting and planning towards Iran. And this was replicated really with some of the type of actions they were planning in Lebanon before that. So it's a difficult relationship, but I would still say that overall, fundamentally, President Trump has been a great friend of Israel, and the president and Netanyahu still have a pretty productive professional working relationship.
Yeah. But look, he's also facing a lot of pressure domestically, more recently from Republicans as well as Democrats. How do you think he balances between those inflationary surges that we've been seeing, but also managing to get his concessions down the line with the Iran truce?
He's in a difficult situation. I mean, he's clearly in a fix. He can't find a deal that is acceptable to either to him. He has his own sort of internal, I think, psychological needs. He wants a deal that's better than what President Obama got or what Biden looked at. He thinks the JCPOA was a bad deal. And he's gone to war over it. So he's got that to worry about as well. In addition to his own psychology, he's also got a situation politically in the States where there's very little support for cutting a deal with Iran and making the type of concessions that are probably going to be necessary.
Well, look, I mean, 1 month from now, theoretically, will we be discussing a breakthrough deal, or MOU, as we've been calling it, or will we be discussing more military escalations?
That's a very good question. It's hard to predict. Right now, if I had to wager, I would say it's going to be more of the same. I don't know that. It does seem that the two sides are negotiating, and that the outer parameters of a deal are being looked at and worked out. But I don't know in a month if that's going to be ripe enough for a deal. That the real problem is that President Trump domestically is facing a lot of questions about why he did this militarily and what kind of deal is he going to be able to get out of it. And it's a very difficult needle he has to thread.
Yeah. Well, this limbo seems to continue. William Roebuck, Executive Vice President at the Arab Gulf States Institute and former U.S. Ambassador to Bahrain. Thank you. Now, U.S. inflation accelerated in May to the fastest pace in more than 3 years as the Iran war pushed up energy prices, outstripping Americans' pay gains. Joining us now is Rajeev Sibal, Senior Global Economist at Morgan Stanley. Rajeev, a pleasure to talk to you always. Look, the market's reaction has been relatively muted to the CPI print we saw yesterday, long awaited, although 3-year high at the headline number. What do you make of it?
I think the market had gotten concerned about the CPI print after the non-farm payrolls last Friday. And so we already had the market reaction. And when we got the CPI print, even though the headline was quite high, the pass-through to core has not been as much as perhaps some people feared. And core was quite benign. And sequentially, core was much softer than it had been last month. And so I think that gave a level of comfort to market participants that we have a counterweight to that strong non-farm payrolls print ahead of the Fed meeting next week.
Well, when it comes to asset allocation, there's so much at play here, whether it's geopolitics, the AI trade. But what matters more when it comes to the CPI print? Is it core or is it the headline number?
So I'm an economist, so I'm going to say core. I think some people, depending on what assets they invest in, might look at headline. Headline affects consumption in the United States, disposable income. High headline CPI eats into disposable income and depletes savings in the U.S. But we as economists view that as temporary if it doesn't pass into core. And our general view is that it's not going to be a material impact on core in, call it, 1 year's time. And so as a result of that, we think about it a little bit more at the core level and focus on how the Fed will think about it, which is at core.
Okay. And speaking of the Fed, does the print from yesterday solidify those prospects of a rate hike, or does it keep things pretty much the same, of hold for now? Is it higher for longer? What are we looking at?
Yes, I think we're kind of holding for the time being. The central bank will look at the non-farm payrolls and look at the threat of inflation potentially surprising to the upside in the future. That core was relatively benign is something that they'll view as positive because you're not getting that pass-through from headline into core. And the other thing I think that a lot of market participants have forgotten about is that tariffs are still there. And tariffs have started the trajectory lower, which we saw in the print yesterday as well. And so these are mixed signals for the Fed, and so we think they'll be on hold for the time being.
Well, look, I mean, am I wrong to assume that markets have been quite comfortable that these resurgences in inflation are driven by the energy crisis and that it is temporary? Is the market getting it wrong?
No, I think what happened is that in the last meeting, we had 3 dissents from the Fed, and that is unique and unusual. And so the market is sitting there saying, even if inflation were to move lower, we can't do that until the dissents go away and until we have a clear indication that inflation is moving lower. And that inflation lower path probably starts deeper into Q3 in probably 2 or 3 months. And you won't have a clear signal until then because, as you highlighted, we're dealing with the top-heavy effects of oil pass-through right now. So I think it's a matter of patience and waiting.
And we'll get back to that. But the next Fed meeting, what are we looking forward to? The 3 dissents from last time, does that continue into more?
I don't think we'll have 3 dissents again. I think it'll be a little bit more balanced. I think we've argued that the statement will get changed a little bit more neutrally, that the easing bias, whatever easing bias may have been in the verbiage, will go away. And I think the thing that the markets need to be focused on and that they will be focused on is this is Kevin Warsh's first meeting. It's going to be a new communication style. Every time we have a Fed chair transition, the market has to learn the style of the new Fed chair. And so I think we'll be hanging on every word. That's what we'll be paying attention to.
And in the midst of all of this, equities remained relatively resilient in the United States. We're still seeing year-to-date gains in the S&P 500. The SOX, my favorite gauge, is up more than 90%. Semiconductors are a strong game. What challenges the market perspective, do you think? Is it more geopolitics? Is it further pauses in the AI trade?
Yes, I think, we've pulled back a little bit, but to your point, we're still very strong year to date. And the escalation in the Middle East would be something that could cause concern. From our perspective, it's anything that disturbs growth. Right now, the equity markets can perform because growth has been resilient, and there's no clear indication that growth is going to falter in the next 1 or 2 quarters in the U.S. Now, if oil were to move past $130, $140, $150 because of an escalation in the conflict, that would be a growth scare. Alternatively, if there were to be some sort of pullback in AI capex, that could be a growth scare. None of that is our base case, but we need something that creates a little bit of uncertainty on growth, I think, to add more questions in the trading markets.
Okay, I will add one more question about the geopolitics. We haven't discussed that yet. With everything that's happening in the region, the latest from this morning, how do you position keeping that in mind?
So we are really focused on how that transmits to the oil price. We have created scenarios, if you will. We recently published our Morgan Stanley mid-year outlook, and in that outlook, we look at what happens if oil moves to different levels. And ultimately, if oil moves materially higher, we actually think that's a growth risk more than an inflation risk. Right. If you are in a permanent oil premium, where oil sits at, call it $110, $120 for 6 more months, that's a world in which you could have disruption into supply chains. And not quite COVID-like, but you could have a little bit broader effect of oil because transportation is disrupted, moving into core inflation. And so the persistence becomes a problem. So persistence versus level and the time horizon becomes what we are focused on. And so far, it's been okay and benign. But if this were to last many more months or the oil price were to move much higher, we would have to reassess.
Well, the latest update in the Iran story was that Iran was saying that it has completely shut down the Strait of Hormuz. The U.S. rebutted that this morning, so we'll have to wait and see what oil does. Rajeev, thank you so much for your time this morning. That was Rajeev Sibal, Senior Global Economist at Morgan Stanley. Now, coming up, Gulf sovereign wealth funds are pouring billions into the SpaceX IPO. We'll have that story next. This is Bloomberg.
It will be interesting to see how they get priced. You need to let 1 or 2 or 3 or 4 quarterly earnings come through on these companies and really see where they are. But are they going to be priced as secular growth, or are they going to end up being priced more as cyclical companies? But right now it's hype and it's just excitement, and I want to buy it because I want to flip it and sell it tomorrow for someone else. It's a gambling trade at this point. It's not an investment, but it's fun.
That was Jeffrey Sexton, CEO of Demeter Tactical Investments, speaking about the SpaceX IPO and other mega IPOs in the United States on horizons yesterday. Meanwhile, Gulf wealth funds have put in orders for shares worth several billions of dollars into SpaceX's IPO. Bloomberg News has learned that Saudi Arabia's PIF and the Kuwait Investment Authority have each placed orders for shares worth $1 to $5 billion. For more, we're joined now by Balazs Pens, Bloomberg Asia Equities Deputy Managing Editor. Balazs, what is the latest we know on the demand for this massive IPO?
Well, it's a massive IPO, and the demand has been massive as well. Every day we've been reporting more and more evidence of companies, investors, retail and institutional investors just piling into this IPO. As you said, we have reporting to show that some really large sovereign wealth funds in the Middle East, the Saudis, the Kuwaiti wealth fund, Qatar, have put in large bids for this IPO. And to zoom out, that's just part of the demand. Earlier this week, we were able to report that there are several orders worth $10 billion or more into this IPO. Now, obviously, nobody's going to get a $10 billion allocation, but that just shows the amount of interest. Overall, subscriptions are more than 4 times the shares available for this IPO. And just to reiterate, we are talking about a $75 billion IPO here. So the numbers are huge. Every time we report it, there is incredible interest both on the institutional and the retail side for this IPO.
And look, Jim Tranos sounded a note of skepticism, essentially, about the valuation of SpaceX. What was his criticism there?
Well, he said that, look, we're talking about a company that has about $19 billion of revenue and is valued at $1.75 trillion. So that's what, 95% over revenue. That's a huge multiple. And his point is that the valuation is not based on the numbers that we see currently. The valuation is based on the idea that this is a space company. And when you sell space, you can sell what he said, hopes and dreams. You can talk about developments that we cannot even imagine. You can talk about data centers in space. You can talk about asteroid mining. You can talk about colonies on Mars. Those are very difficult to price, and that's what people are being caught up in right now. While the other part of the investors who look at the numbers, who look at the actual books of the company, may not be convinced by those valuations.
And look, for most investors here, the appeal is Elon Musk and his business empire. How does the broader Musk world with other companies like Tesla X affect this deal?
Well, Elon Musk is front and center of this IPO, and consistently, as we've been talking about investors, be it institutional investors or retail investors, about this IPO, about their plans, about how they think about it, a lot of them come back saying, look, this is Elon Musk. He has the vision. He is driving this company, so we believe him. We trust in him. But for a lot of people, they look at the way his companies are intertwined, whether you talk about Tesla, XAI, SpaceX, all the other Musk companies, and they think, well, there might be some synergies and there might be some advantages of these companies working together, but for others that creates a little bit more of an opaque structure, which makes them think a little bit slowing down their enthusiasm for this company. So it will be very interesting to see after the initial hype dies down a little bit, where people end up on valuations for SpaceX.
Yeah. Balazs Pens, Bloomberg's Asia Equities Deputy Managing Editor, with the latest on SpaceX. Now, coming up, we will look ahead into the ECB meeting chaired by Christine Lagarde, as the bank is widely expected to raise rates. This is Bloomberg. Welcome back to Horizons Middle East and Africa. I'm Abir Abu Omar in Dubai. Oracle shares fell in extended trading after fourth quarter capital expenses came in higher than estimated, overshadowing AI growth. Oracle has refashioned itself as a provider of AI computing power, embarking on a massive build-out of data centers for OpenAI and other customers. It plans to raise up to $40 billion in equity and debt by fiscal year 2027 to fund further expansion. And OpenAI says China-linked accounts use ChatGPT to stir opposition to U.S. data centers. It says the accounts generated English-language posts raising concerns about rising electricity costs and were probably tied to a private Chinese tech firm that they did not name. OpenAI says the postings did not have a wide reach, but should raise concerns about foreign attempts to undercut a strategic industry. And KKR says markets may be underestimating AI's power demands. The firm's head of real assets says there are signs of frothiness in digital infrastructure, warning that too much may be built relative to current demand. KKR says it's not taking a view on AI growth, but is instead focused on positioning for the opportunity. While equity futures in the United States are turning higher, Asian equities lower, oil prices higher after escalations this morning, and coming up, fears of stagflation are starting to ripple through global credit markets. We'll discuss that with Victoria Harling next. This is Bloomberg. Good morning. This is Horizons Middle East and Africa. Our top stories this morning. Oil is rising as the U.S. completes a fresh set of strikes in Iran for a second day in a row, after President Trump accuses Tehran of dragging out peace talks. Global equities hit a one-month low as the tech-led sell-off deepens and the war in Iran shows little sign of ending. Plus, investors gear up for SpaceX to go public, with the order book believed to be more than 4 times oversubscribed. That includes Gulf sovereign wealth funds ordering shares worth several billions of dollars. It's just gone 8:30 a.m. across the Emirates. I'm Abir Abu Omar in Dubai. Now, we're seeing what geopolitical events are happening in the Middle East today. That's slightly reflected in the equities picture this morning. In Asia, particularly, U.S. futures, not so much, 0.4% higher this morning. Now, this follows a 1.6% close on the lower side for the S&P 500. Investors really not factoring in the CPI PPI report that came in yesterday as danger signs come in. It is the highest headline number in 3 years, but lower than expected generally. So you're seeing a little bit of positivity in the U.S. futures picture there with underlying risks overall. Asian equities, however, 0.5 lower this morning, not as much as a massive move compared to yesterday. The Kospi was trimming losses in the session earlier on. And then oil prices is really where the story is today. Fresh escalations in the Middle East, a second day of escalations really, with the U.S. hitting Iran and Iran retaliating across some countries in the region. The yield on the 10-year notes not doing very much this morning. But for what markets in Asia are doing, we have Winnie Su in our Hong Kong studio. Winnie?
Good morning, Abir. Actually, we had a pretty volatile day here in Asia. As you can see on the board, this is the intraday move of MSCI Asia. At one point, we did pair losses and, in fact, was in the green when that headline dropped that the U.S. has completed the latest attacks on Iran. But you can see that that ended up becoming quite a brief relief, and that the downward pressure still is pretty much on in Asia because of the uncertainty around that real resolution. And also oil prices remain quite elevated, and also ahead of that SpaceX IPO that everybody is watching out for. Now you flip the board, we take a closer look at some of the moves in the key benchmarks, because we have Kospi, in fact, as you mentioned, reversed losses of as much as 4% earlier today, and now in the green, driven by some of the rebounds in the chip makers like Samsung and SK Hynix. But worth flagging today that the MSCI China down more than 1%, and it's now just about 1% away from entering the bear territory. So in fact, Chinese stocks, Hong Kong stocks have been doing pretty badly so far this year, and that is partly dragged by today Alibaba down about 5%, and some concerns around their pricing for the AI tokens after Wall Street Journal in fact reported that OpenAI is considering massive price cuts. Now when it comes to Japan, the Japanese yen still holding right about that 160.5 level against the dollar. Unfortunately, we did hear that BOJ's Governor Ueda is hospitalized and won't be able to attend the central bank decision meeting next week. But for now, market is still expecting one rate hike to come, but we'll be closely watching out for the speech from Deputy Governor when during the presser. Back to you, Abir.
Winnie Su in Hong Kong with those market details. Now, fears of a stagflation shock are starting to ripple through global credit markets as higher energy prices and inflation put pressure on corporate borrowers. Joining us now to discuss is Victoria Harling, Middle East CIO and co-head of emerging market corporate debt at 91. Victoria, thank you for joining us this morning. Now, look, the narrative has changed very quickly from an imminent resolution in the Middle East to more prolonged fighting. We were thinking by June this would be over, but it doesn't look like that would be the case. So what does this prolonged fighting mean for risk premiums and for the outlook on credit generally in EM?
Look, I think the markets have had to deal with a number of black swan events over the last 5 years, so much more akin to taking risk events in their stride. Clearly, the biggest impact that we're seeing is on global inflation dynamics, and actually you could argue that looking at the jobs data that we saw in the US is encouraging that actually growth is holding up okay. And I think realistically, from a risk perspective, what we've seen of spreads compress to compensate for the inflationary dynamics of underlying interest rates, which is exactly what we would expect to happen. And going forward, we continue to expect overall yield to be a determinant.
Well, look, I mean, a lot of sovereigns and corporates in emerging markets have spent the past few years sort of extending maturities and working on their balance sheets. Do you think that leaves them better positioned than peers in developed markets if rates stay higher for longer?
100%. I mean, I think what we've seen so far in the last 12 months has been a very careful response from central banks to control the level of rates, balancing growth risks with inflationary risks, and they've done a very good job. And in fact, I think since the tariff of last year were implemented, what we've seen is much more rational response to inflows into emerging markets that continue to be very positive, by the way. We've seen more recently equity market outflows, but fixed income inflows have been strong. And I think that this pairs back to more rebalancing of domestic flows back into home markets, for example, which is helping central banks. But yes, in terms of government balance sheets, etc., you can still see that emerging market growth looks reasonably robust even under this scenario.
And within emerging markets, Gulf countries, for example, are benefiting from higher prices of crude despite the delays in shipments and the physical lack of ability to get those shipments across. But do you think that the equation going forward starts to become a comparison between emerging markets rather than the traditional distinction between developed and emerging markets?
Well, I think we've seen AI being the real distinction, and you've seen and reported this morning, continue to report on the flows going in and out of Asia, whether it's Korea, Taiwan. But I will say with the Middle East, what's quite striking from a corporate perspective, clearly a lot of the companies here are very robust. We've actually seen the lowest default rates of any region here in the Middle East, showing the corporate resilience. And I do think even when you look at growth, actually growth in the Middle East, despite the fact that the conflict is happening here, outshines that of many regions because the backdrop of government spending to diversify the economies continues to hold up very, very strongly. So, you would expect the Middle East to be suffering the most, but actually it isn't.
It's an interesting take. And look, I mean, this might be a little bit of an obvious question, but I keep thinking about 6 to 12 months from now, the biggest risk to EM sovereigns and corporates, what is it, in your opinion? Is it tighter monetary policy? Is it the weighing down that we're seeing on global growth, or the prospects of a weighing down on a global growth?
For sure, it will be global growth sentiment. Clearly, as we start to come into new trade discussions, whether more tariffs are coming on, developments on USMCA and what happens there. But I think what you're seeing is a strategic move to a multipolar world where emerging markets are very keen to make sure that they do business together. So you will continue to see this strategic push away from just the West. But for sure, more tariffs, more inflation, more pressures on global growth will weigh on the global economy. It's still reasonably well linked.
Well, Victoria, thank you for that take. Victoria Harling, Middle East CIO and co-head of EM Corporate Debt at 91. Now, the U.S. military has launched strikes against multiple targets in Iran for the second straight day. This is after President Trump accused the country's leaders of dragging out talks for an interim peace deal. Let's bring in our Asia energy reporter, Stephen Stupczynski, for more details. Now, Stephen, officially, we're still in a ceasefire, no matter how fragile it may seem today. But military action continues by both the United States and Iran, really. How is the market reacting to the latest strikes overnight?
Well, when you look at Brent and WTI, prices have gone up a little bit. We're not seeing a surge. Brent is still below $100 and far from the highs that we saw back in March in the early days of the war. But I think the main thing to focus on, though, for the market is, does this spiral into a wider conflict? And so far, these limited attacks you've not seen that. You've seen this mostly between Iran and the United States and Israel to an extent. And while there have been limited attacks, it seems that there will be these spate of missile fires or drone strikes, and then you would see an announcement on one side, either Iranian or the U.S. saying this operation has ended. So clearly both sides want to show that this isn't spiraling into a larger war. This isn't threatening the ceasefire in place. And I think that's what the market is closely looking at, that this is, obviously not good, which is why prices are up, but it's not a worst case scenario where you see Iran potentially targeting oil infrastructure across the region like we saw in March.
And look, President Trump has said that the U.S. supported more than 200 tankers through the Strait of Hormuz. How are traders really viewing the chances of a resolution and full traffic finally resuming to the waterway?
This is a really interesting topic because for a long time we've been looking at ships with AIS on, which indicates, they're sending their signal, and we were tracking which ships were going in and out. And if you just look at those signals, there are essentially no ships going through at all. But what's happened over the last few months is that more vessels have been turning their AIS off. This is the transponder that sends their signal for ship tracking, and they're going through dark, essentially. And according to Bloomberg reporting, not only are they going through dark figuratively, they're also doing it literally. They're turning off their lights and going through in the night to hide their location. And what's interesting here is we have known, there are banks saying, and there have been estimates by trading houses about how much oil has been going through. Trump's claim of 100 million barrels, if you look at that since the ceasefire started, let's just take 50 days. That equates to 2 million barrels a day. That's still a tenth of where we were pre-war. Plus, if you look at what he said, 22 vessels going through, that's still far below the pre-war level of 135 plus vessels. So while there is some oil going through, and that is correct, whether it's 100 million barrels, whether the U.S. is assisting with it, if they're actually providing safety support and security for these shipments, that's still a bit unclear. But either way, it is still a far lower level than the pre-war times, and that does result in ultimately a tighter market.
Bloomberg's Asia energy reporter Steven Stupczynski, thank you. Now, for a look at some of the other stories that we're following, the Qatar Investment Authority's deal-making push may be hampered by Iran's attacks on the country's energy infrastructure. The conflict is expected to cost Qatar about $20 billion in lost revenue after Iran attacked its key LNG plant in March. A spokesperson for the QIA says it is continuing to pursue deals across sectors and geographies. And Russia has sent an additional consignment of military equipment to Madagascar. The shipment includes mobile power plants and vehicles and will help re-equip the island nation's military engineering troops following a coup last year. The support from Russia comes as it challenges France, Madagascar's former colonial power, as a major foreign partner. And coming up, all eyes are on Europe as the ECB decides whether to raise rates. Details on that next. This is Bloomberg. Welcome back to Horizons Middle East and Africa. I'm Abir Abomar in Dubai. Bloomberg Economics is expecting the ECB to raise interest rates by 25 basis points when it meets later today. Many traders are expecting 2 further hikes over the course of the year. For more on that story, we have Bloomberg's Oliver Kluck in Frankfurt for us. Ollie, is it fair to say that the increase in today's ECB meeting is confidently predicted by markets?
I think it would be a shock to everybody if the ECB didn't raise interest rates today by 25 basis points. It's been very well advertised from the governing council members speaking up into the sort of quiet period ahead of this rate decision. Everybody in the market has basically said this is locked and loaded and this is a done deal. But I think for the markets, the big question is going to be, what does the outlook going forward? What is the ECB's appraisal of inflation, of growth in the coming months? And we will get new projections from the ECB a little bit later today. We'll also get that press conference from Christine Lagarde where she will be grilled about, again, what she sees in terms of that stagflationary dynamic that we've been talking a lot about in Europe, which is basically inflation rising, which we've seen in May go up to 3.2%. Core is rising as well. Core actually accelerated at a much faster pace than the headline number, which is what's worrying the ECB. And of course, then the concerns about what that will mean for growth going forward. We had a contraction, a surprise contraction in the euro area in the first quarter of this year. That was a sort of massive reduction downward. That was down to an anomaly, though, from the sort of Irish economy, which contracted about 12%. That was really sort of, if you strip that out, growth has been a bit resilient. But the real question is, what does growth look like going forward? And that is going to be one of the questions that are going to be put to the ECB a little bit later today.
Well, there's the consensus, as you mentioned, that the ECB will hike. But is there a consensus that it's a good idea?
I mean, definitely not. I think that is what you hear. You hear some market commentary from a lot of the people, a lot of the economists, a lot of people saying that really this is not the moment to hike, that actually they're sort of traumatized by what happened in 2022 when there was this sort of idea that the ECB moved a little bit too slowly to act on inflation. But there are a lot of other economists that speak and say that actually what you're more likely to repeat is not the error of 2022, but the error of 2011, where you hiked interest rates prematurely and then had to capitulate and start cutting interest rates very, very aggressively. I mean, we spoke to Jeff Yu a little bit earlier this week, who said that basically if you get a hike this week, you're going to get the ECB cutting again in the fourth quarter and turning around. So not necessarily consensus there, though expected widely to get that 25 basis point increase from the ECB later today.
Bloomberg's Oliver Crook with those details. Now, coming up, South Africa's plan to split Eskom is drawing scrutiny from investors and ratings agencies. That is next. This is Bloomberg. Welcome back to Horizons Middle East and Africa. I'm Abir Abu Amr in Dubai. Now, South Africa's plan to break up Eskom is raising fresh concerns among investors who warn that separating the utility's most profitable assets could weaken its financial position. The debate centers on Eskom's transmission business, a key earnings driver that the government wants to turn into an independent system operator. For more, we're now joined by Paul Burkhardt, Bloomberg Africa energy reporter. Paul, walk us through this. Why is South Africa splitting Eskom into separate units?
Good morning. So South Africa, Eskom is about 100 years old. It's been the monopoly power utility in South Africa. The whole time it helped it to industrialize, and it runs mostly on coal. A few years ago, there were severe power cuts that curbed economic growth here. And so the government came up with a plan to split Eskom into three separate units, generation, transmission, distribution. And that would help liberalize the grid, bring in private producers and bring in renewables and really make a major change in the system. And so the issue that we're at right now is spinning out the transmission unit, which is the most valuable asset for Eskom.
Yeah. And look, what are the obstacles when it comes to completing the spin-off, and how does it really raise credit concerns?
Sure. So the reason that Moody's and the bondholders that we've spoken to, the issues that they've raised around this is that transmission is the most profitable part of Eskom. It's responsible for about, it brings in about $2 billion of earnings in the last financial year. And so what would happen after that spun out completely to create a transmission system operator that's fully independent, that means it's not under the group of Eskom anymore. And that impacts Eskom's ability to pay back debt, to expand. It wants to expand it to renewables. And so those are the issues they're raising. Also with the existing creditors to get paid back, they also want to know how this is going to work.
And how is Eskom reacting to this plan?
Eskom's kind of taking the official line of, the president is the last in February said that it would fully be spun off. It's kind of gone back and forth in terms of within the government about what they're going to do, whether they're going to spin off all the transmission assets now or they're going to do it later. When the president said that in February, that they're going to do it fully right now, of course, Eskom said, sure, we'll go along with that. But they have gone to court over trading licenses, electricity trading licenses, and other things. They're going to remain competitive, or they're going to take action to remain competitive. And so it's a little of both, I think.
Yeah. All right. Well, Paul Burkhardt, Bloomberg Africa energy reporter. Now, for sports stories, the FIFA Men's World Cup kicks off today, with Mexico, one of the home teams, playing against South Africa. The 48-team, 104-game tournament is being hosted across the United States, Canada, and Mexico. But the world's most famous football competition is being overshadowed by political tensions, affordability concerns, and worries about the United States' aggressive immigration policies. A Somali referee has been denied entry at the border, while an Iraqi player was detained and questioned for 7 hours on arrival at an American airport. For FIFA, the event promises to earn $13 billion, but with dynamic ticket pricing being used for the first time, many Americans are finding matches unaffordable. Attendance is also expected to be impacted by the threat of aggressive immigration enforcement hanging over visitors to the United States, as well as its minority residents. Now, before we head out to the end of our show, let's take a quick look at where markets are today. S&P futures turning higher by the second 0.5 higher now. NASDAQ futures, after a drop yesterday, are about 0.8 higher, and Dow Jones is also rising. Euro Stoxx 50 future probably feeling the pain from the Middle East, 0.4 lower. Now, oil prices are ticking higher this morning because of the escalations that we're seeing out of the Middle East, something to keep an eye on. Well, that's it for Horizons Middle East and Africa. I'm Abir Abu Omar in Dubai. Stay with us for Daybreak Europe. This is Bloomberg.